morning, everyone. This is Kelly with Premier Life and Annuities, and I would like to thank each of you for taking time out of your morning today to join us and Mary Reed, the National Director of Pension and Protection Planning at Pentegra Retirement Services, as we have Session 8 of our We Mean Business series, and today's topic will be profit sharing and 401k plans. And we'll keep the lines muted, and if you do have any questions, please feel free to type them in and we'll address those at the end of the presentation. Thank you very much. Mary, it's all yours.
All right, thank you very much. Hopefully everybody can hear me fine. This is the third in my series of these. We've done defined benefit plans. We talked about distribution strategies, and today we'll talk just about profit sharing and 401k. This is a huge marketplace. Certainly, we know there are 401k plans everywhere out there in businesses, big and small. So there's lots of opportunity. If you work in this marketplace, you work with business owners, you will run across these plans, but there's lots of opportunities also to put them in place. So that's where we're going to focus, and I'll be happy to answer any questions that people have at the end. So what are we talking about in the world of defined contributions? That comes down to profit sharing plans and 401k plans. We used to have money purchase plans, and there are still some around, but we don't write money purchase plans anymore. Nobody really does. They used to be much more popular when the contribution to profit sharing plans used to be limited to 15% of payroll. We'll get to that in a couple of slides. And money purchase plans, you can put in 25%. So there was a 10% additional amount of contribution you could do in a money purchase plan. And so people who wanted those bigger contributions would do them. A number of years ago, they brought the profit sharing contribution limit up to match the money purchase limit. So now everybody just does profit sharing because you can put in just as much money but still have flexibility. So we're going to talk about profit sharing and 401k. That's our defined contribution world. We'll talk a little bit about the IRA plans because they are defined contribution plans. You know what you're putting in, so we'll talk about those briefly. So we'll start at the very beginning. Here's our little sample company. We have Pat and Chris who own the company. Their child Drew is in the business with them, and they have 2 employees. So a pretty typical, little closely held company. The family members and a couple of employees, which would be very common out there. So a typical plan you might see in this kind of a company would be a SEP. Now a SEP is an IRA plan, but it is a defined contribution plan. What defined contribution plans define how much you can contribute to the plan. It's as simple as that. So any plan that does that falls into the defined contribution category, right? With a SEP, we know what percentage of pay you could put in. We have no idea how much money you'll have when you ultimately retirement. From any defined contribution plan, it's a question of how much money that earns, what the investment performance is, how many years you contribute, those kind of things. So SEP's very, very common. Lots of times the CPA will be the one who prompts to put in a SEP when they're doing their client's tax returns. SEPs are the only plans you can set up after the plan year has actually closed, so after the tax year is closed. Let's say the tax year end was December 31, doing the taxes in March, you could still set up a SEP for the prior year. So these are all over the place. If we did a SEP here, the most anybody could get currently in a plan contribution, in a defined contribution plan, is $53,000. In a SEP plan, whatever percentage we give to the owners, everybody has to get the same percentage. So in this case, giving Pat and Chris their $53,000 means everybody else is along for that same ride. We end up giving $9,000 to employee 1, $6,000 to employee 2, and $15,000 to Drew because everybody has to get the same percentage of pay. The other thing with a SEP, we can't change that formula. There's no way to manipulate it. It's just that's what it is. And all the money will be deposited in IRAs, so it belongs to those employees as soon as that money is in. If they quit tomorrow, they get to take that money with them. Employers don't usually like that part of the provision, but it's simple, it's easy, it's free to do. So another option in the defined contribution category in the IRAs would be to do it simple. So if we have an employer who is satisfied with less money, because here the salary deferral limit currently is $12,500. If you're 50 or older, you can also do the catch-up for another $3,000 deferral. And then the simple has a required employer contribution here, a match. So Pat and Chris would pick up $79.50 as match. So now we could get the owners here to $23,450 instead of $53,000. If they were satisfied with that, this could be fine. And you'll see the expense for those two employees is far less, because all they're on the hook for, the employer, is to do that required match for those two employees. In this case, $1,350 and $900. If the employees didn't defer, they wouldn't get anything. So this is can be a very cost-effective plan if they're satisfied with that amount of money to put in. Again, it all goes into IRAs. Lots of simples around. They certainly have their place. But when we step into the world of the true qualified retirement plans, now we're talking profit sharing and 401k, we get more features. By stepping into the true qualified plan world, right, these are not IRAs, these are qualified plans. They're under Section 401A of the Internal Revenue Code, a different section than the IRAs. We get different rules, and we get to play with them a little bit more. We have more control. Contribution limit in any of these plans will be 25% of the participating payroll. So I'm an employer. I have a plan. I have a profit sharing or a 401k. My employer contribution into that plan, not the salary deferrals, but my employer contribution can be as much as 25% of the total payroll for everybody who's in the plan. That's what I can contribute and deduct. I can always do less, but that would be the maximum. Once a contribution is made into the plan, it is allocated among the participants. So it's divided up among the participants by some formula that's in the plan. On that individual level, no one can receive more than 100% of their pay to a maximum of $53,000. That $53,000 goes up with cost of living every once in a while. It used to be every year, but not anymore. It has stayed again at $53,000 for this year. So let's talk about, we have a company like our little sample, and we have some employees who are not family members. Well, typically, the conversation with the employer will center around they don't want to give those employees any money. Very common. Occasionally we find employers who do, but lots of times they don't. Like any qualified plan, we talk about this plan is designed around you, the business owner. What are your objectives? Where do you want to get to? We're going to design it around you, and we may be able to design the plan that is efficient enough that those employees won't cost you anything. Well, how could that be? Well, because if we can design a plan where the tax savings, because of the deduction, exceed whatever we have to put in for the employees, then we'll come out ahead. And the employees won't really cost that employer anything because Uncle Sam will pay for the employees. So then sometimes we get into a conversation, well, don't I have to cover everyone? And the answer is no. Most people think that they do, but we do not have to cover everyone. We can if we want to, but usually employers are looking to not cover everyone. So first of all, we have eligibility rules, and this would be for every qualified plan. It's typically age 21 and 1 year of service. We cannot use an age later than 21 to exclude people. We can use 2 years of service instead of 1, but not in a 401k. In a profit sharing, we could. But if we used the 2-year eligibility, everybody would have to be immediately vested as soon as they came in. If we use 1 year, we can use a graded vesting schedule. That's usually a 6-year graded vesting schedule. So right away we have eligibility. If that employee is not age 21 and let's say they haven't been there a year, they're not in the plan. But once they hit the year, they'll meet the eligibility requirements. But that still doesn't mean we have to let them in. There are ways to exclude people in a qualified plan. We have to pass certain testing, but we can exclude people if we want to. So being eligible doesn't mean you are a participant. We have to let you in the plan. So once you're in the plan, that means you'll actually receive the contribution. But we must pass coverage tests. We can't just keep everybody out. So here's an example. There are a couple different tests. This is the basic one that says we divide our employees into 2 groups, highly compensated and everybody who is not highly compensated, which is a very specific definition, which will include the owners, is non-highly compensated. The percentage of the non-highly compensated eligible employees that we include in the plan has to be at least 70% of the percentage of highly compensated employees we included in the plan. So here's a little example. I have a little company here with 2 highly compensated. Let's say they're 2 partners. They're both eligible. They're both in the plan. I have 10 eligible, non-highly compensated employees. If both my owners are in, I could exclude 3 of those non-highly compensated and only have 7 of them in the plan. Usually the way we would exclude would be by job title, job classification. Now I could go a step further. Let's say my 2 highly compensated, one of them waives out of the plan. Maybe it's a spouse. Now we only have 1 of the 2 eligible participating, so it's 50%. We only have to have 70% of 50%. Now we're down to only having to include 4 out of those 10 employees. And we could exclude the other 6. This is all legal. This passes the coverage requirements. We have to do it by a non-discriminatory basis. Job classification is what we would typically use. You know, we couldn't say like all the women are out of the plan, but we can use something that is non-discriminatory. So this is not a tool that every business owner is going to use or that we even want to explain to every business owner, but if we're having a conversation with a business owner who's really insisting and resistant to putting money in for those employees, let's talk about it. Tell me who you want to favor and who don't you want to favor. Tell me what you're thinking. We'll see what we can do. Sometimes if they have employees at different locations, maybe they don't want to cover different locations. We did a case recently. They were willing, they wanted their more senior employees, the ones who had been with them for a longer period of time in the plan, but they wanted to exclude ones who had been there for a shorter period of time. We were able to do that with this rule. By job classification, we had senior positions and junior positions. So there's lots of creative things you can do with this. So if you start from the premise with that employee, and the first thing they say is, I won't do a qualified plan because I'm not going to put money in from all of my employees. I understand that. Tell me what you want to do. Let's look at your group and let's figure out what we can do. All right, so let's talk about the specifics of profit sharing first. So the profit sharing plan, once we get past the eligibility and participation, it is all employer contribution. In a profit sharing plan, we don't have salary deferrals. When we do that, then it becomes a 401k. This is purely employer contribution. We talked about the contribution limit will be that 25% of the participating payroll, and each participant could receive as much as 100% of pay to a maximum of $53,000. So my employer makes the contribution. There'll be a formula in the plan document that says how we're going to divide it up. There are 4 ways. The first would be proportionate to pay. That would be just like the SEP. Everybody gets the same percentage of pay. The second one, known as permitted disparity or integration with Social Security, takes into account the fact that in the Social Security system, if you make above the wage base, you are discriminated against. You don't get any additional retirement benefit on that money. So years ago, the IRS said we could equalize that in the private pension system. So it enables us to give an extra piece of contribution to people at that high pay range, equivalent to what they would get from Social Security. 5.7% is the number. We get to massage that number a little bit. There's ways to kind of play around with it, but essentially that's what they're going to get. So we're able to give a little extra kicker to the highly paid people. The third way brings age into the picture. This is, these rules were given to us in 1991, and here we're doing our discrimination testing on future projected benefits rather than the current contributions, and the IRS is good with that because in their eyes, we want to have even benefits at retirement. So if I have 2 people making the same amount of money and one is 55 and one is 25, they would be entitled to the same benefit, let's say at 65. Well, the 55-year-old only has 10 years to get there. The 25-year-old has 40 years. So we have to put in bigger contributions for the 55-year-old. And that all passes the IRS testing because we're testing at that future retirement benefit where they will be equal. So contributions in these plans will favor anybody who's older. So if we have an older owner and younger employees, we're going to look at an age-based option. New comparability uses that same testing, but there are some more nuances in the testing. This enables us to do that same testing at retirement age, but now we can divide our employees into groups, give different groups different contribution rates, and so long as when we project their benefits, they're comparable, is equal. It gives us more room to work with the numbers, and this is a plan design strategy that gives us the control to kind of decide who we're going to give the bigger contributions to and who we're going to give less to, as long as we do it right and we pass our testing at age 65. So the best way to see this is to kind of play it out with our little group here. So we're back to our same little company. And on the upper left of the screen looks just like the set, right? Everybody gets the same percentage. 53,000 for Pat and Chris, 9,000 and 6,000 for our 2 employees. If we go to the one on the upper right that says permitted disparity, now we can't give Pat and Chris more than 53,000. That's our ceiling, right? But by giving them that extra little kicker, when we do the balance of it, we're able to give a little less to those employees. So rather than 9,000 and 6,000, we're down to 75, 82, and 5,055. So it saves the employer a few $1,000s on the presumption that they didn't really want to give that money to the employees. So this is a little more efficient plan design for them. Now, if we go to the one on the lower left, this is the age base. Now we bring age into the picture, and the age will drive the numbers, age and compensation. So you see now Pat and Chris are not equal because they're different ages, and I can't fix that in this design. Employee number 1, we got their contribution down really low, but employee contribution, employee number 2 actually went up because I think they were 61, I think, in a sense. They were older, and that's driving that number. So now when we go to the one on the lower right, which is the new comparability, this is where we get the most control. With the control of the tools of this plan design, we're able to get Pat and Chris to their 53,000. Now we have employee 1 at 2,250 and employee 2 at 1,500. So imagine you're this employer, you know, and you put in a SEP. Your CPA helped you put in a SEP. It got you the nice deduction. You and your partner got you 53,000. And you're putting that 15,000 in for your 2 employees, and you're like, it's not terrible. It's, you know, I'm still getting a lot of money. And then we go in and show them, look, you could still get your 15,000, but instead of putting 15,000 in for those employees, you could only put in 3,750. Which one do you think they would rather do? My experience is they would rather have the 3,750, and that's all about just doing plan design. And getting them the right design. So here's what it would really cost them. In that new comparability plan, the total contribution for everybody is $115,389. Their tax savings because of the deduction is $39,232. I think that's in a 34% bracket. So that makes the net after-tax actual cost to them of the plan $76,159. That's what they're actually laying out. The other $39,000 is coming back to them from the IRS. The total contribution, $115,000. The 3 family members are getting $111,639 of that. So they're coming out ahead, $35,482 by doing this plan. So that means they pulled back $39,000 in tax savings. Yes, we had to give $3,750 to those 2 employees, but the rest is going into their pocket. So yes, this conversation may have started, I'm not contributing for my employees. So I don't want to do anything qualified because I'm not contributing for them. Let's just wait and see how the numbers play out. Because if they refuse to do the plan just because they have that objection, saying no costs $39,232. Well, we could say yes and put $35,482 in your pocket. Which would you rather do? All right, so let's move on to 401k. So that's profit sharing. Now, if we add a salary deferral feature into the profit sharing plan, it becomes a 401k. All 401ks are profit sharing plans with the added feature of the employees being able to make salary deferrals. So the features you get, right, employees can make pre-tax salary deferrals. If you're age 50 or older, you can make a catch-up contribution on top of that. You could make those salary deferrals instead as Roth, so they'd be after tax and come out tax-free in the future, or you can split them and do a combination of both. You will have optional tax-deductible employer contributions in here as well, because it is a profit-sharing plan. You could have matching contributions. You could have what's called qualified non-elective contributions. That's like a flat percentage the employer puts in to pass testing. And you could have profit-sharing contributions in any of those forms we just looked at. All the money here will have tax-deferred growth. It will be taxable eventually when it comes out. except the Roth deferrals. If you do Roth deferrals, it goes in after tax, but then it's all tax-free when it comes out in the future. The nice thing about the Roth deferrals here is that for people who make above the allowable threshold to have a Roth IRA, that threshold does not apply in the 401k. So they might not be able to do a Roth IRA, but you could do an $18,000 Roth salary deferral here if you wanted to. Go down, go down. Where are we stuck? There we go. Okay. So the contribution limit. Again, remember it's profit sharing, so the employer contribution, 25% of participant paying payroll. That would include any matching, any qualified non-elective, any profit sharing contributions, but that number does not include the salary deferrals. So salary deferrals are on top of that, but at that individual level where the salary deferrals would count, as well as the employer money, nobody could get more than 100% of pay to a maximum of $53,000. The exception to that is the catch-up contributions, which right now are $6,000, are on top of that. So if you were 50 or older, you could actually potentially get $59,000 in a 401k. $53,000 in the profit sharing, but if you add that 401k feature, you get the catch-up, you could get up to $59,000. So there are several different kinds of 401ks. There's the traditional one that's been around since 1981. There's Safe Harbor, and I'll talk about that a little bit. We use a lot of Safe Harbors. The solo K is a one-person 401k plan, and then the Roth 401k, which is just any of these 401ks with that Roth provision to make the salary deferrals after tax. All right, so traditional. Let's start with basic. All 401ks have these limits. To do a deferral, the deferral limit is 100% of pay up to $18,000. And you have to do the catch-up, you have to turn age 50 sometime during the plan year. And if you do, you can do a $6,000 catch-up on top of that. And obviously the plan has to permit for that, but they all do. Eligibility, 21, 1 year of service. The employer contributions here can be subject to a vesting schedule. Salary deferrals are always the participants. Those are always immediately vested. If we're doing a traditional, straight, plain vanilla 401k, we do have what's called the ADP test, which stands for Average Deferral Percentage Test, that we have to pay. So pass. So what that test says is our highly compensated employees, their salary deferrals are controlled by what the rank and file do. So if you're the owner of that company, I can't just tell you you can defer $18,000. It depends what all the employees do. I have to pass a test. And statistically, this is the test on the screen. We don't need to get into it, but a good average salary deferral without any other incentive from rank and file employees is about 3%. So if the employees were deferring 3%, the owner could only defer 5% of pay, which is not going to get them to $18,000. And some companies, the participation will be even lower. Anybody who doesn't defer counts as a zero to average out what the actual deferral percentage is for the non-highly compensated employees, and it drags you down. That's why we do a lot of safe harbor plans. And smaller companies and big companies, they'll be the traditional because the safe harbor would get too expensive. But in smaller companies, we do safe harbor because safe harbor is a version of 401k. There's a required employer contribution here, which we'll get into. But if you declare your plan a safe harbor, you avoid that ADP test. It goes away. So now I can sit there and look the business owner in the eye and say, you can defer $18,000. Even if no employee deferred anything, they could still do their $18,000. So you can still have the Roth provision. Now, it has a mandatory employer contribution, which will either be a match or a flat 3% for all the eligible participants. I'll show you the test in just a second. You can still have profit-sharing contributions in here as well. The safe harbor required contribution has to be immediately vested. So no vesting schedule. The profit-sharing contribution can be on a regular vesting schedule. So here's the required employer piece. If they do a match, it's a dollar-for-dollar match on the first 3% of pay that anyone defers, and then a 50-cent match on the next 2% of pay that employee defers. There's no flexibility to that. That's the rule. That's what it is. If they don't do the match, instead they could do a flat 3% contribution for all the eligible participants. So even if that participant doesn't defer, they would still get the 3%. If you use the matching option, you don't get it if you deferred. There are reasons why we choose one option over the other when we're doing plan design. I'm not going to get into that right now because that's a lengthy conversation, but that's part of the design process. But that's what safe harbor means. When somebody tells you they have a safe harbor, or we ask you, is the plan safe harbor? That's what we're trying to find out. All right, so let's talk about some other variations on the 401k. We've got 401ks for one, right? These are frequently referred to as solo Ks out there in the marketplace. And these came about when they changed some rules a while back. And here's the advantage of a solo K. If I have someone who has, let's say, a second source of income, and so they don't really need that money to live on, they want to tax shelter as much as they can, you could do a SEP, absolutely, and put away 25%. So my example here, I have somebody who's got $100,000 of earnings. They could do a SEP or a profit sharing and put away $25,000. But if instead we did it as a solo K, they're not participating in a 401k somewhere else because the deferral is the only limit that runs to the individual, not the plan. So if they weren't deferring anywhere else, we could set up the solo K. They could do their $25,000, but also make an $18,000 salary deferral, plus make a $6,000 catch-up if they were eligible, and actually shelter $49,000 of that $100,000 instead of $25,000. All flexible. These are nice, easy, simple, flexible plans for people who have that kind of income, and they work really well. We do lots of them for people. Very inexpensive to set up, and we charge $250 to set it up and $700 a year to administer it. You know, it's a very inexpensive thing. You can buy insurance in here. There's lots of things you can do with these plans. All right, so let's just kind of move on here, and we'll be done soon, and then I'll take questions. And let's just talk about what's going on in the 401k marketplace. So, you know, the 401k marketplace, you kind of divide into three categories. You've got those little solo Ks. Those are, you know, sole proprietors, one-person businesses. Then you've got the closely held business 401k arena, and usually those 401k plans typically are being not so much done for employee benefit, but because they're a more efficient plan design for the owner to get to their goal. If I'm trying to get that owner to $53,000, I can do it with less layout for the employees if I include a 401k provision than if I don't. So a lot of times it's just a plan design question. And then we get into the bigger companies. And by bigger, I don't mean huge. I mean maybe 30 lives and up, where they really do want the 401k. It really is an employee benefit program. And so they have lots of issues to contend with in terms of expenses and operation. And now, of course, we have the new DOL rules. And even before that, in the last 5 or 6 years, we've had new rules about disclosures, new rules about expenses, new rules about fiduciary responsibility. So a lot of things have been happening in the 401k arena, a lot of focus on 401ks because the government has realized that these are great savings plans but terrible retirement plans. And most employees now are in 401ks and are finding, you know, they've been around now since 1981, so you have people trying to retire on their 401k balances. What happens if the market takes a crash right before you want to retire, and now maybe your retirement savings just got cut in half? How do you protect against that? So let's talk about the different roles of a 401k. Obviously, you have the employer. They're going to hire a TPA, the third-party administrator, who will administer the plan. But in between those two, you have what's called the record-keeping function. And I find a lot of people don't really understand what record-keeping is. Record-keeping is the system. It has all the investment accounts on it, and it gives the employees access to those accounts. For example, think about a typical 401k. Maybe you have 10, 15, 20 investment choices. You could go online 24 hours a day. You could probably call an 800 number 24 hours a day, and you can move your money between those different funds. You could decide to change your investment mix at any time and move them around, and you wouldn't suffer surrender charges. You're not buying and selling like you would be if they were your individual private accounts and you wanted to move from your Templeton account to your American Funds account, because they're all record kept on one platform. That platform gives that email access, and it keeps all the records of where the money is. The plan administrator actually is online with that platform, so they get that data to do their job. And on the front side, the employee sees it and sees where all their money is. On the back side, the administrator sees it, and all the funds are kept on that record-keeping platform. You need that in a 401k. There are vendors who offer product that's already on a record-keeping platform. You can build a record-keeping platform. The TPA can. We do. It's called open architecture. It's usually what that's referred to. But all the funds have to be on some kind of platform. So it's just the nature of the beast. So then there's a question of who is the fiduciary. This has become a hot topic in 401k plans, not only with the new DOL rule, but with rules that have come out over the last several years that are really focused on who has fiduciary responsibility. And it's a very big responsibility. When you are a fiduciary to a plan, you are personally liable for what goes on in that plan. So there's been a new kind of market has emerged for 401k for fiduciary services. It kind of falls into three categories, from employers who will say, do it for me. Do all of it that you can. You can never offload 100%, but you can offload about 98%. Do it for me. I don't want the responsibility. Middle ground would be, help me do it. I'm willing to hold on to some of that responsibility, but I want to offlay some of it. And then at the bottom of the pile here is, no, I'm going to do it all myself. Most of this is a matter of cost. It costs money to offlay that fiduciary burden. People aren't going to do it for free. So here's just some kind of statistics about what goes on in 401k plans. This is from 2011, so a couple of years ago, just to give you an idea. There were 10,000 Form 5500s, that's the tax return for the qualified plan, that were audited. Almost 6,000 VCP is voluntary compliance. That's where the employer says, yes, I made a mistake, I'm going to comply. What do I have to do to fix it? Almost 6,000 of those. Department of Labor, civil investigations. Remember, this is before the new rules. 3,476, almost 3,500 civil investigations, with 75% of those resulting in payment, with an average payment of just under $400,000. 255 of those cases were referred to litigation, with 75 convictions, and there were almost 9,000 ERISA lawsuits. This is a very heavily regulated, there's a lot of exposure here, there's a lot of activity, so employers should be concerned. They need to be thinking about what they're doing and be aware of what the risks are. But also, everybody thinks about the investments, but if you think about, Alyssa was here, a lot of it's about the administration. People get sloppy. We run into it all the time with employers. We have to make changes, maybe an amendment or a document restatement. We send it to the employer for signature. They never sign it and send it back. That's a failure. If they get audited, that's going to be a failure. So, all employers should be thinking about where they want to be on that risk ladder. How much risk do they want to hold on to? How much risk do they know they're holding on to? It's important that they're aware of that. Regardless of what their decision is, they need to be aware that they have that risk. I talk to employers all the time who don't know that they have that risk. So let's talk about the funds for a minute, because that's what most people think about. But here's an example. Here's a plan with 20 funds in the lineup, typical. But they have the same lineup as they did 5 years ago. They haven't changed anything. 7 of the funds are large cap. They have a gap here because they have no mid cap. They have small cap, and they have 5 sector funds. They thought on the sector funds they were in pretty good shape. Under the current rules, 40% of these funds would fail. The new fiduciary rules, and we don't even know what the implication is of all the new DOL rules, but the rules that were already standing, what they want that employer to do is at least have a process to evaluate those funds on a periodic basis, probably no more than 2 years. Doesn't mean you always have to change, but that they should be evaluating. The law is clear that you can outsource a lot of that fiduciary responsibility, but if employers want to do that, they need to be careful about what they're buying, because it's kind of a new marketplace and there's stuff all over the place out there, so you just have to know what you're really getting. Here's the 3 primary fiduciary roles you could outsource. 316, which is the administration part. You can actually outsource all that, not only by hiring a TPA, but actually outsource the fiduciary liability for doing that. Discretionary trustee, that's someone who's managing the funds. You could outsource that. A 321A, 3 fiduciary is appointed for specific purposes that'll be defined by the plan. And then you can also have what's called a 402A named fiduciary who has overall responsibility. They have the most responsibility. There's a couple of things you can never offload, like choosing who that fiduciary is going to be, but that would offload almost all the responsibility. So it's a great world, 401k. It's great business to be in. There's loads of plans out there. There's opportunity. There's a huge amount of money in them, but it's not for the timid. There are a lot of components to it. There's design. There's the performance of the funds. There's the cost of operating the plan, and there's the fiduciary responsibility. All those elements have to come together, and to come together right. Now, the new DOL rules, which I'm not going to talk about today because we're still digging our way through the 1,000 pages of regulations, certainly are going to raise new issues on the investment side for how those investments are built on the platforms and how they're priced. We'll see. It's a year before those rules are implemented, but it's going to be interesting to see how that may alter how we think about 401ks today. So in a perfect world, what we want to ask the employers, how much do you want to contribute? Which employees do you want to exclude? Which ones perhaps do you not want to include? And who do you want to favor and who don't you want to favor? And then within the law, we'll design a plan that comes as close to that client's idea as perfect as is allowable. And as we talked about, there are a lot of tools to help us do that. So hopefully when we get it right, what we help business owners do is preserve what they've worked so hard to build, hopefully guide them to the retirement they want, and also protect their assets from catastrophic loss, because 401k profit sharing, just like all qualified plans, are fully protected from creditors, so it's a very safe place for them to put their money. So with that, I'll be happy to take any questions. I haven't had my question screen open, so I don't know if any have come in, but if there are questions, I'll be happy to try and answer them.
Thanks a lot, Mary. That was very informative, and we do have just a couple of questions. Is the 34% based C Corp option, would that be the same percentage for an S Corp?
No, and we can reflect whatever their actual tax rate is. For an S Corp, it could actually be higher because they're actually paying at their personal tax rate. So it could be lower, but a lot of times the S Corps actually come in at a higher tax rate, and it'll vary by what state you're in as well. If you're in California, it could be as high as 60%.
Great, thank you. And the only other question I see out here is what's available in the state of New York?
Well, the 401ks that's all federal, so they're available under the same rules everywhere. So there'd be nothing different about doing it in New York. I'm not sure, I don't know all state law about what you can deduct on the state return, and it varies somewhat by state. But all these plans are under federal law. The creditor protection, the amounts you can put in, how they work, is the same in every state. The only thing you might run into, occasionally you'd run into limitations on insurance or annuity vehicles because you have to use what's approved in that state.
Okay, and one other question just popped up, and I think you kind of answered that a little bit. It was, does insurance enter into the plan?
Absolutely it does. You can have insurance in any of these plans, not the SEP and Simple, but any of the true qualified plans. We do a lot of that. Our firm has a specialty in administering that insurance. I work with putting insurance in plans all the time. And there are some strategies that actually make it a very, very advantageous place to do the insurance. Number one, you're paying your premiums with pre-tax dollars. The pure death benefit is still income tax free. And there are some unique strategies where we actually use insurance to reduce taxation on those accumulated money. So there is definitely a place for life insurance. And also on the other extreme of this can be a way to provide an added benefit to those employees, those participants in a profit sharing plan, for example, include insurance. You just add an employee benefit with no added cost to the employer because it just comes out of the contribution they're already making.
Great. Thank you so much, Mary. I don't see any other questions here. If you do think of some questions that arise after we end this presentation, you can certainly reach out to one of your life marketers here at Premier. Our number is 800-365-8208, and we can certainly get that question answered for you. Again, thank you everyone for your time. Thank you, Mary, and we will see you in 2 weeks with session 9.
All right. Thank you very much. Have a great day, everybody.